and I think it's so important for investors. Really identify your goals and what you want. You gotta do that. You cannot do this blindly. None of this happens by mistake. Really identify what you're trying to obtain, and then do the same type of research
All right,
regarding.
everyone. Welcome back to another episode Behind the Doors. And now you guys are probably looking at me and you're seeing the panel here. They look a bit different. They're not the people from before. That's why, because today we got mortgage lenders here, and they're going to go ahead and give us advice and strategy as far as us as the investors on what are some things they see as products that they currently have, things that they're seeing currently in the market. So they're here to drop knowledge in, from that aspect. You know, we all need money. So I'm glad everyone's here with us. Also, where I want to stop you guys for a second. If you are watching this, how this platform has helped out, I need you guys to go ahead and subscribe. With subscribing, you're already here watching it. It gets out to more people. If you feel that this is a platform that's been helping you, please share the link. I ask that favor. So we're going to get into it as far as introduction of the panel today. Connor, if you want to go ahead and start off.
Yeah, thanks, Gus. Hey guys, my name is Conor Whiting. I'm a branch manager here in Westbrook, Maine, with a guaranteed rate and an investor myself since I got into the mortgage industry. So 5 years ago, got in. My brother's a realtor down in Mass. So essentially, I was looking for something that fit into sales, and I was always into investing. Essentially, just wanted to go all in, and I'm licensed in Mass, Maine, Connecticut, New Hampshire, but I'm really focusing primarily on that Maine, New Hampshire, Mass market. So thank you.
Awesome, awesome. My name is Shad Hammond. I am Philly. I'm coming from Philadelphia, hailing from Philadelphia. Shout out to my New England folks up top. I am a lender as well, mortgage lender. I'm a team leader at Loan Depot, a branch down here in the Philly area. I predominantly serve first time buyers, first time investors. I have 39 state licenses overall. I don't keep them all active at a time. I'm like Connor, I'm predominantly regional. So I'm PA, I'm Jersey, I'm Delaware, Maryland. I will do Florida, I will do Georgia, I will do North Carolina, and some of the higher price point states throughout the country. And I've been doing this, for lending, mortgage lending, about 10, 11 years. And I'm also a licensed agent. And like Connor mentioned, I did catch the investing bug, and I haven't lost it since. So I am an active investor, and I do counsel the clients that I serve who do enjoy or want to dip their toe in investing.
Awesome. My name is Alyssa Caliendo, and I am with Cross Country Mortgage. I work out of two different time zones. So the Northeast, Connecticut, Massachusetts, Rhode Island, New Hampshire, Maine, and then California at large, but specifically Southern California. When I'm in California, that's where I'm located. I've been originating now for just about 7 years total. Before that, I was working in legal compliance for a mortgage company and have a background as a tax attorney. I swore I'd never work in mortgage. I got into it. It was a family business and I wanted to go a different path. And somehow I still got pulled in. It's been great. It's been a crazy ride, but it's really fulfilling working with buyers and helping them achieve their goals through real estate. It can be a phenomenal tool for building wealth, for building generational wealth. If you can get started really at any time, but get started early and go about it the right way. So building out a team to support you, I think, is the most important thing early on. And we've got some phenomenal panelists on today to give you all the advice you could need when it comes to mortgage lending.
Boom, I like that. I like it. Nice wrap of it. I may not even have to talk after that one. I like that one very much. But here's
Make
where
your
I
job
want
easier.
here's where I want to say integrity. That's something that's real big with me. Um, I didn't just go ahead and try to find who got the most followers on Instagram and none of this stuff because I'm not doing this for clicks. And I'm not doing this to get views. Where I went on to go ahead and put this panel together because I've been watching them from a distance. And I've been seeing their progression without most of them even knowing. So I wanted to go ahead and get people I've been watching, bring them to this platform so you're getting real knowledge, you're getting real sauce at the end of the day. So once again, this is what this page is about. It's about integrity at the end of the day. So we're going to go ahead and get started because these are the guys that are giving out the money. The important part of real estate investing, we need to get the money. We can go ahead and look at properties all we want, but what are the conversations we're having with the panel right here that's going to get us the money that we need? Where do we need to be? All right. So the first question is, the seats you guys are sitting on right now, what are you seeing as far as investors in 2026? Are deals still penciling out? Are you seeing a lot of investors have to go ahead and change up normally what they have done in the past? So let's get an overall perspective with working with investors. What are you guys seeing?
In Maine, I'm definitely seeing a lot of investors fighting over limited inventory for sure on residential units. I mean, I think the secret's out on multifamilies and it's kind of been out for a while now. So, I'm getting more and more first-time investors that are coming to me. They used to not even think about a multi. They used to come to me, hey, I want a single family. And then they'd realize, hey, payment's a little high. Like, what else can I do? And then they'd eventually progress to thinking about a multifamily. But now people are coming to me, I only want a multifamily. How do I do it? It's much different now. And I think if you're a first-time investor, if you're factoring in the alternative, which is renting, a lot of these multis still do pencil. It's just, I think it's more important now more than ever to have like a 1 year, 2 year plan, 3 year plan where it's like, how am I going to bring some value to this property? It's not going to be 5 years ago when you could buy a 3.5% down FHA loan and live in a unit for free. Maybe now you got to get one person out, fix up the unit, add value, have like a 3 year plan. Those are the people that are, if they're looking at it that way with a real plan in place, not just what it looks like on day one, those are the people I'm seeing, be successful on my end.
Connor brought up some really good points in terms of still being active, even though margins that you see now may not be the same as the margins you've seen 4 or 5 years ago, but they still pencil, they still work. And what we notice about what we all essentially know or should know or eventually learn about real estate investing is that time is probably the biggest currency, right? We want cash flowing properties, but we also know time and activity, getting active, buying something, getting something, holding something, if that's your lane, if you're a buy and hold investor. Time is one of your biggest assets, is your biggest currency because we are starting to see, yeah, the margins might not be that big now, but as you're paying down, on that mortgage or on the loan that you have, you're also developing and generating equity on that property. And so, what margins that we were seeing during the pandemic, and like you said, you're living upstairs, someone's living downstairs, and they're paying your entire mortgage. Yeah, those days might have passed, but we're starting to see, still equity. We're starting to see properties appreciating, even though they're slowing down, still appreciating at a consistent rate. I think for me on a personal level, what I'm seeing the most is the need for creativity. I'm seeing investors have to be more creative because, they may not have up to date tax returns, right? Or they may have showed a ton of loss last year, or properties aren't cash flowing like they used to. And we know that, right? And so, we're starting to see the need for all three of us can mention that we're starting to see more non-QM deals come across our desk more than anything. And that would be bank statements. That would be profit and loss, transactions. Where 5 years ago, who was really looking at those as a DSCRs, right? Who was really securing them like they're securing them now?
Yeah, I think to echo all of that, it really just depends on what your goals are, right? I mean, so yeah, a deal might not pencil if you're looking for a property to immediately cash flow. You think real estate investing is a get rich quick scheme. I've heard people talk about it on some podcasts as, a passive income play. And sure, it can be that, right? That's the goal. Like when I'm building out my own real estate portfolio, the goal is to have passive income to allow me and my partner to be able to retire earlier or just have flexibility in deciding what we want to do in our future. But right now, that's not the primary focus. When I'm looking at a property or evaluating a deal personally, I have to get super clear on what my goals are. And I might have a plan A, plan B, plan C, but you have to know what your goals are and what you're willing to do and what you're willing to take on. So multifamily purchases, yes, they're still penciling in most markets that I've seen, even in Southern California. Single family homes, potentially, if you find a good opportunity. But it's also like, are you interested in fixing up this property and either using the BRRRR method for investing or flipping it? If you have the ability and the skills to be able to renovate properties on your own, and that's your play, then maybe it doesn't matter to you if it's cash flowing right now. Maybe you'll take even a $100 or $200 a month loss on this property for the potential down the road, whether that's equity on sale, doing a 1031 exchange, whether it's refinancing on a cash out to grab that equity and purchase another property, keep building out your portfolio with the same pool of equity. So you just have to know what your goals are. I feel like one of the younger investors I spoke to recently did need to adjust their expectations. They wanted to purchase this single family home at all costs because they just felt emphatically like it was a good deal. And there was really no product available for them that would make the numbers make sense. And they just kept trying to want to fit a square peg into a round hole. And I'm all for like not giving up and being open to things, getting super creative. And then at a certain point, when the people advising you, whether that's your real estate agent, whether that's your mortgage lender, tell you that what they're trying to achieve isn't realistic in this market based off of what we're seeing right this moment, you've got to be able to take that in at a certain point.
All right, no, that's a lot of great information. And just to throw out for the people watching, then not only are they the people, the panel people on the money side, the lenders, they're also investors also. So when they're speaking from their point of view, they have different hats that they wear to be able to go ahead and give you that information and create those strategies with you. We're gonna have a lot of newbies who watch this, and there's a few things that the panel said that I want to circle back on so they have an understanding of that. And Chad, you brought up the non-QM loans. Can you dive into that? And I'll let you, Connor and Alyssa, if you want to build upon where he starts.
Yeah, so what's pretty cool is the panelists, we all work for big box lenders. So most often a home buyer um, may look to us for an FHA loan or a conventional loan or a VA loan or a USDA loan. But companies like ours have had to adapt over the years because those loan products, those traditional loan products may not work for us, right? And we might be that square peg trying to fit in that round hole. So now you're starting to see more box lenders like us, but also private lenders, hard money loans. You're starting to see a lot of different ways to skin a cat. And one way that we three can help you is through non-QM lending. And so those loans would be, for an example, could be a profit and loss statement loan. And so if I'm the guy that, hasn't paid his taxes in 3 years, please, we're covering our ears. But if you hadn't paid your taxes in 3 years, or you've shown tremendous loss, but we know that you're really, making cash flow at your business, at your job, right? Profit and loss statement might be a way to get a loan. Bank statement loans, where a lender is looking at 12 to 24, maybe even 36 months of your deposits from work. So bank statement loans, profit and loss loans, um, limited doc loans, right? No doc loans. Those will be examples of non-QM lending where we talk about creative financing in the lending institutions that you'll work with.
I know we'll get to it later too, but DSCR loan is also a really popular non-QM product. I would say of all the non-QM that I do, it's heavy bank statement, heavy DSCR, and the DSCR, for those who aren't familiar, is debt service coverage ratio loans. That's all fancy speak to say, do the prospective rents for the property cover your proposed mortgage or housing payment. If they do, you're approved. No income docs, no debt to income ratios. Usually DSCR loans are much more forgiving on where the funds are coming from. Doesn't mean that like traditional rules about money don't apply. You're still not supposed to, quote unquote, be using, cash just deposited into a bank account for a transaction. However, the way DSCR sort of sidesteps that is that oftentimes we don't actually have to source funds up to a certain dollar amount. So it can be a great solution too for people who have money coming in from weird sources, or not necessarily like below board sources, but they just don't fit within the four corners of conventional loan guidelines or traditional loan guidelines. DSCR products can be great for people who are investing for the first time in certain markets, but particularly for experienced investors, because you don't have as many documentation requirements. And you'll find that as you start to build out a real estate portfolio, if that's part of your goal, that you need to provide documentation for every single property that you held. And the DSCR loan will allow you to get around that.
So let me ask this question real quick about the DSCR loans. Now, I haven't done one, but I'm in masterminds and talk to people across the country. There's certain criteria that you need to meet with that particular property that you're looking to purchase with that type of loan. What is that criteria? I believe it's like 1.3. But if I'm wrong, I need you guys to help correct me. And how do you come up with that formula for anyone who wants to answer that question?
Yeah, so I mean, most of the products are just 1-to-1 ratio. So you're just looking at the principal, the interest, the taxes, and the insurance. And if the rents are equal to that amount or greater, it works. You can even go as low as 0.75 with some investors as well. My favorite thing about DSCR loans is that they're not all just 30-year fixed loans, which, helps me do my job to help them and let them and make it work for them. There's 40-year DSCRs, which for me has been huge with the rates being higher, just keeping that payment down for them. And also for cash outs. I recently had somebody, they wanted to cash out an investment property and buy a new investment, but they really didn't want to kind of kill that investment that they were pulling money from. So we did a 40-year cash out. It still allowed that property to cash flow, and put them in a good spot and let them, acquire a new property. There's even like interest only DSCRs. So there's a lot of flexibility in that space. It's not a cookie cutter product. It really allows investors to kind of pick their lane, and, you don't have to hold it for so long either. Sometimes it's a short-term solution to help you get your next one. And then you kind of maybe now all of a sudden your tax returns are looking good. You can go to a bank and get that rate real low. So there's all different things that people are doing. Sometimes it's just a short-term bridge.
I'm happy you brought that up right there, because what I have heard, I'm just being transparent, but everyone has their starting points, and it looks like this type of loan is a good starting point. But those DSCR loans tend to be on the higher end when it comes to interest rates. Is that a fair assessment that I have with that?
Absolutely.
Yeah.
Okay.
Yeah, they can be for sure, but with the higher usage of them now, we've seen rates be more competitive now than, let's say, 2 or 3 years ago, before they were everybody's favorite loan product. The same way, and I'm glad we're talking about it, the same way the guidelines have now gotten more and more flexible depending on the lender. It used to be the ratio that you asked about, Gus, was like 1.15 or 1.25, right? You had to have 1.25, you had to have like 20 to 25% down. You've had to have, 3 to 6 months of reserves. And now we're starting to see, since everybody's using it and we're also in a higher rate market, banks who want your business are starting to flex on a lot of those rules and guidelines. We're seeing shorter terms. We're seeing less. We know some will go down as low as 10%, some as 15%. We're seeing, like Connor mentioned, sometimes 1-to-1. I've seen 0.85. I've seen 0.75. I don't think I go as low as 0.75, but like we're starting to see like all of this flexibility, whether you're working with us or other banks and lenders. The more people use the product, the more competitive it gets. right? And so now we're starting to see those terms be more relaxed. But the fundamentals are always going to be the same. Does my acquisition cover the cost of servicing? That won't change.
I think it's important too, like when you're thinking about the DSCR loan, for some people, it makes sense right out of the gate. For others, it might make sense. And that just goes back to, I'll probably say this 100 times today. It depends, and it depends on what your goals are, right? Like, usually, anyone who's dabbled in real estate investing knows that usually the timing of deals, like, you can never plan that perfectly. And so sometimes you have a really awesome opportunity for a property, but your income is what's not working at that moment, or your assets for down payment and sourcing those funds would not work at that moment, and you don't have other options. And the DSCR loan provides a solution for you. You can make a decision based off of what your goals are for that property. If it makes sense, can I handle this payment at a slightly higher interest rate for 6 months, 12 months, 18 months? How does that affect my pro forma and the numbers that I'm running for this property if I'm looking for it to cash flow? How long can I hold that and tolerate it? And does getting into this property give me an opportunity to renovate all of the units, dramatically increase the rents, dramatically increase the value of the property, and turn around a year or two from now and do a refinance, whether that's rate term or cash out, and open yourself up to other opportunities. So the rate is going to be a little bit higher, but to Shad's point, we are seeing that space become a lot more competitive, especially in 2026. And if the rate's a little bit higher, but you can get the deal done and actually make this goal a reality, that's a lot better than, a low rate where you'll never get approved and never have a path forward.
That last part is key. If the rate is dictating if this is a great opportunity or not, then you don't have a great opportunity. Most times that's what I think about it. All right, so we went in about non-QM loans. Now I want to peel it back because we went a little deep, but I want to bring it back to if you're a newbie and you're watching this. A thing Connor brought up in his opening was limited properties, limited inventory right now. Are all you guys seeing that? And let's talk about that. Is it hard for investors right now to find something?
I think it
Yeah, still
depends.
seeing challenges, but I mean, I let bicoastal listen. I let bicoastal
I think
listen
it
in if you
depends.
got those
I
markets.
mean, like, so in Southern California, maybe this will be surprising to some people, but the inventory is actually growing and growing, and it's flipping a little bit faster to being more of a buyer's market. And so investors specifically have seen a lot of opportunities this year. If you, even in the multifamily space, but single family as well, flipping back to the Northeast, it really, for me, has just been geographic. Like, where exactly within a specific state are we? I do a lot of business in Hartford County in Connecticut. It's competitive. There's not a lot of inventory. I had a client looking to purchase a single family home over the weekend. And granted, this was for owner occupancy. It wasn't for investing purposes, but 69 showings, 18 offers, multiple cash offers. And so if you're trying to invest in that type of area, you're going to run up against that same competition. So I think it's so, so important all the time, but especially right now when inventory is tight, to get your team around you of local advisors who know the market that you want to be in. Because it's true when you're buying a property for your own occupancy, but so important when you're investing that you know what's happening in that local market, like down to the nitty gritty, because that's going to dictate what opportunities you have. It's going to dictate your plan for the future. It's going to dictate your exit strategy. And so again, when we're talking about like super low rates, if you're just hopping online and working with whatever online lender has the lowest margins and the lowest cost to produce, and no brick and mortar locations and no people really on the ground who are willing to talk to you, that's an option. You can do that. I don't think it's the best thing for you as an investor, because they're not going to have any knowledge of your local market. They're not going to know the appetites of sellers. They're not going to know where there's room to negotiate on things other than price. So it depends. It'll be my answer to, again, 100 times. But you can absolutely find opportunities if you're willing to explore what's right for you depending on your goals. You're not gonna flip a property in certain neighborhoods. Like I am interested in flipping. My family had a mortgage company, but my dad was always a contractor. And so I'm comfortable with things like that. But you can't just flip a property in any neighborhood or any county or any city. It doesn't always make sense. And so you've got to figure out what works in the areas that you're in, that you're going to be investing in, and then kind of back into your strategy from there.
Kind of, let me bring this up to you.
Yeah.
As far as FHA buyers coming to your, first time home buyers and their conversation is, I want to invest. What does that conversation look like with you and them at the beginning?
So they're coming to me directly, just wanting an FHA loan right off the bat.
Yeah, yes, correct. And they're what they're telling you is, hey, I want to invest in the multifamily because I'm seeing it all over social media. And let's just be honest right now. Investing in real estate is somewhat cool now. 10 years ago, I wish I knew about this 10 years ago because I would have started 10 years ago. But right now, everyone's talking about it. I got people coming to me, Gus, how can I get started? X, Y, and Z. So if you have a client coming to you, Connor, what does that conversation normally look like? And then on your end, what add value are you bringing that potential client?
So it depends on their profile. Like, some people fit into an FHA loan and they have, it's tough too. It's like a lot of the multis, as we know, they have deferred maintenance. Like a lot of them are going to be tough to get done with an FHA loan. Like, if you're going up against a conventional offer, you're going to lose. So if there's somebody that can be approved very high with an FHA loan and they can find a multi that doesn't have any deferred maintenance, I'll keep them FHA because it'll work for them. But if they're in a price point where I know they're going to be probably looking at something with a lot of deferred maintenance, I'll talk to them more about, okay, let's give you both options. Let's pre-approve you with an FHA, and let's also pre-approve you with a 5% down conventional multifamily product. That way, when you go out there, depending on what you see, and I really lean on my realtor partners. Like it matters who you work with on this end as an investor, but it also really matters who you work with on the realtor side. You work with, I work with a lot of good realtors that are also investors. They know what it takes to get a deal done, but also to keep it under contract because a lot of those multifamilies, they have deferred maintenance. You got to negotiate a lot with the seller. So it takes the right agent to keep a deal together, keep their clients calm. So I usually refer them to those agents. But I usually give people both options, an FHA and a conventional, just depending on what they run into, as far as the property itself.
No, I'm glad that you brought that up, and I may have just thrown that out there for you because a lot of times I run into agents, all they talk about is the FHA, and there's multiple government funding loads that they can go about. What you just told me, if FHA doesn't work, I'm going to talk about the option as far as conventional. And that's what I'm assuming everyone's shaking their heads. That's what a good lender is going to go ahead and do. They're not just going to be laser focused. Another good thing you brought up, especially up here in the Northeast, we got a lot of older homes. Some of these older homes don't qualify for the FHA funding. So that 3.5% down, unfortunately, won't work for that particular home. So kind of, I really, really like that answer that you gave right there. Shad, you brought up creative methods. Can you dive into that a little bit as far as
Yep,
purchasing homes?
yep, I certainly can, but I gotta rewind because I am literally 80/20 probably FHA to conventional. So I'm a bit of a unicorn. Most of the markets that I serve, the Newarks, the Wilmingtons, the Trentons, because I am licensed in Cali, NorCal. I do a lot of Sacramento,
Yep.
right? A lot of my buyers are cash strapped, but yet they have the awareness that Gus has mentioned in terms of, hey, real estate investing is cool, or passive income is cool, or house hacking is cool. So
Generation wealth.
now they have, right,
Mhm.
generational wealth is
Yep.
cool now, right? That's the catchphrase, hashtag right? So we're starting to see so much more awareness from our buyers. But a lot of them still in this big 2026 aren't cash heavy, right? And unfortunately, if you ever want to step into this space, you cannot do it for free and you cannot do it broke, right? You can't be a real estate investor with no money in your pocket. You got to have reserves because we know not only does your loan, product may call for you to have reserves on paper, but also like, what are you going to do when you buy a house and now you got to repair it? Now you got to, throw a new water heater in there. As soon as you bought it, now all of a sudden the house is leaking, right? And
Mhm.
so you have to have reserves on hand. But with the FHA, what I do like is about that 3.5%, um, is something that also helps inventory are like 203K loans. 203K loans are a great remedy, either FHA or even conventional home style, but FHA 203K loans are a great remedy for in inventory challenged markets where you can buy a home at in any condition, essentially offer that buyer, that investor, the same financing process that they would have had in it. You're not doing anything different, but you're saying, hey, you can buy that house that needs that TLC still with that 3.5% down. And if it's 1 or 2 units, not have to have the 4, 5, or 6 months of reserves, especially if you're a cash strapped buyer, um, that maybe conventional might ask for, right? Or, so again, thinking along the lines of being creative, but also still kind of reaching back and talking about those FHA loans. FHA loans offer a lot of different opportunities for buyers that want to step in this space, but may not have 20 grand in reserves, for emergency funds or, for reserves that might be called for due to the loan product that they're using. Hopefully that answers something.
Mhm.
This is why working with a lender who knows what they're doing is so important. You guys have heard Conor and Shad talk about all these blind spots and things you need to be aware of with these loan products that might not be obvious to you. And so when we're talking about investing and building out your advising team, having somebody in your corner who will have these conversations with you at 7 o'clock at night or over the weekend when you just got done touring a property to weigh in and give their 2 cents of things you need to be aware of as you're penciling everything out, it's so, so valuable. And it can help give you options in real time to weigh and decide what works best for you and best for your goals. Conor talked about FHA versus conventional side by side, Shot about the 203K solution. Another reason why it's important to have options for FHA versus conventional when you're looking to get into a multifamily property is because with FHA at a certain point, in certain markets and certain price points, depending on the rents, you're going to start to run into self-sufficiency test issues for multis with 3 to 4 units. And so that's something that could start to hold you back, and you might be able to get the deal done conventional. And that's a great solution for you and something to be aware of. And the self-sufficiency test, quickly, just for people who aren't familiar, when you are using FHA financing to purchase a 3 to 4 unit property only, this doesn't apply to 2 unit multis, you have to make sure that the rents for the property discounted by 25% are enough to match the proposed mortgage payment, or housing payment, I should say, not just principal and interest, it's taxes and insurance, and PMI as well, if that's in play. Very, very similar to that debt service coverage ratio conversation we had before, but in the sense that the calculation is done in largely the same way. But that can hold you back. So you've got to know not just like, what's this property listed for? Your lender in certain cases needs to get on the phone with the listing agent and be like, give me the breakdown of the rents and the tenants who are in there right now. And are those tenants long-term tenants? Are they month to month? Because if they're month to month, now we might have some flexibility where if the current rent they're paying is under market value, we can rely on a higher market value and a rent schedule and an appraisal report to get this deal to work. But you've got to have those types of conversations. Those are the types of things that will kill deals. And if you are not working with somebody who is willing to even talk to you about those things, you are going to find yourself in tough spots. And you're gonna learn by experience more than you need to. That's important. But try to save yourself from it when you can.
All right. No, that was very good. So let me ask you this, and this is what a lot of newbies are coming to me with, and I think it's from, you guys may or may not be familiar. It's called the the M the MG guy from out of New York. I forget what his name is, but his method is the 4-3-2-1 method, where you purchase a 4 unit first, live in it for a year, transition a year from there for a 3 unit, and move down year after year. What's your guys' opinions on that particular method? Is it the best method to use for someone who's starting out that may not be cash heavy like Chad went on to go ahead and say?
I mean, that's music to my ears if somebody came to me and said they wanted to do that, because I'd be like, finally, I get a lot of first time investors. They come to me and they're all excited. They want to invest. And it's like, all right, are you a first time buyer? It's like, no, I bought a single family last year. And I'm like, all right, that makes it a little tougher with underwriting, and that's the thing is I always tell people to come to me a year before you want to buy, a year before you want to get into investing, because we can do it the right way and just make it so much less stressful. And that is a good method, start big with an FHA loan. Like Alyssa mentioned, still has to pass self-sufficiency when you're doing the fours and the threes, but that is a great way to do it because ultimately what underwriting is going to say to me if I'm trying to do a primary multi for a buyer is if they're moving from a 2 unit into a 3 unit, and let's say they were in a 3 bedroom in that 2 unit, and now they're going to say they're moving into a 1 bedroom in the 3 unit. It's hard to make that case. People are really looking out for that. I'm not saying I can't get it done, but it makes it harder. It makes the underwriting a little bit more scrutiny. So if you can start with a big unit and work your way down, it makes a lot more sense in an underwriter's eyes. So it is a good way to do it.
Yeah, and because I'm not 100% familiar with that, so is that, and correct me if I'm wrong, are you doing a let's say it's FHA, are you doing 3.5% down on the first house, then you move out? Are you refining that 4 unit, or you're able to move on? Maybe I don't know the ins and outs of it. Can anyone explain that?
Yeah, so you can if you want to keep buying with an FHA loan. If you're dead set on using 3.5% down to keep purchasing properties, the rule there's a few exceptions, but the general rule is that you cannot hold two FHA loans at one time. So if you use FHA to purchase that 4 unit, you want to step down to a three, you want to use 3.5% to purchase that three. What you're going to have to do is just refi that 4 unit property before you do that. Now, there are a few exceptions. If you happen to meet those requirements just organically, then yeah, I mean, we can make an argument for it. But it's occupancy fraud is on the rise. That's what they're looking for when Conor was talking about underwriting, taking a look at things a little bit more closely. They really, really want to make sure that you're not just trying to skirt the rule of not being allowed to hold two FHA loans at once. So you can't really like fake meeting the exceptions to that rule. It's something that we can talk about up front. Sometimes if you're purchasing a property that's a lot farther away, if you can demonstrate that that makes sense for you for work, whatever the case may be, it can be done. And I love making those arguments when we've got the facts to support it, but we're not just going to like make them up out of thin air. So if you're looking to do an FHA loan 4, 3, 2, 1 and step down, then you just need to make sure that you refinance that into a conventional loan before you close on the purchase with the new FHA loan. So you can either do that months ahead of time, or you can do it at the same time simultaneously. I've had multiple transactions running in my pipeline at the same time for the same buyer, same borrower, where they're refining their current FHA into conventional so that they can use FHA on their new purchase, and they have them going side by side. And as long as they close on the same day, or the conventional refi closes before the FHA purchase, that's allowed. So I have a past client who wants to do basically exactly that, just kind of in the reverse. She purchased a 2 unit with an FHA loan, 3.5% down a couple of years ago with me. She wants to get into a 3 unit. The thing is, she can't hold two loans at once. So we've already talked about, we can either pull the trigger on that refi for the conventional product now, or anytime between now and when she wants to buy, if she doesn't want to feel hurried and rushed and under the gun. Or we can hold off until she finds something and explore it. But we've already had that conversation. She's not looking to purchase this 3 unit property until probably July at the earliest, but we've had that conversation already, so she's prepared.
Yeah, I actually have, and you rarely, like you said, Alyssa, you rarely get a chance to use it. But if anybody wants to nerd out like us, the 100-mile rule for FHA. Like I'm actually using that right now where someone's moving from DC to Philly and literally like we're Google Mapsing like the distance to see if we can occupy two FHAs at one time. But to go and that the guy that Gus is referring to, I think is MG, the mortgage guy.
I mean, if somebody's trying to go real fast too, I mean, you don't have to refinance that FHA, it can kind of speed things up. Time's definitely
You're there
not.
now.
I would say, you don't have to refinance that FHA. A lot of times I recommend people because it takes a while too to kind of build that equity. So if somebody wants to move fast and they want to do one property a year, I tell them do the FHA, then do a 5% down conventional, and then another 5% down conventional. Now you have three properties in 3 years. And then maybe by that point, that FHA now has enough equity to refinance it. But a lot of times, if somebody's trying to move fast, refinancing isn't always the right move.
Just to finish that point, thanks, Gus. Is that buyer bought with me duplex FHA, right? And that was like 3 or 4 years ago in a hot spot. Not only is he trying to do what Alyssa mentioned, is now he's got a refi because he would love to use the FHA again, but in switching to a conventional loan, just for the sake of using the FHA again, he was able to pull some cash out because his property appreciated so fast that he was able to do not only the refi to free up his FHA status again, but he refied, pulled cash out, and is now home shopping now for his next multifamily property. And so bringing it all back home, it's important and Alyssa keeps saying this, and I think it's so important for investors, really identify your goals and what you want. You gotta do that. You cannot do this blindly. None of this happens by mistake. Really identify what you're trying to obtain, and then do the same type of research regarding the market, right? You got to know your market. And then thirdly, you would underwrite your deal, right? Pencil it out. See, what the cost of renovation looks like. See what the margins are going to be. Again, none of this happens by accident. So she just keeps saying it. And every time she says it, I'm like, I love that. She's saying, identify your goals. Like really transparently. It's not just, I want to get a multi-unit this year. But like where? How much? What's your budget? What's your margins? Why?
Yeah.
No,
Yep.
those are all good questions. And I'm assuming those are conversations you guys are having with the client up front to get a better understanding and point them in the right direction or give suggestions on your end. So this is probably my last newbie question I always get. Hey Gus, I'm buying the property. Do I need to live in it for a year? Anyone want to go ahead and tackle that? Some people like to live in the gray area, I would say, and they're moving. Next thing they're getting mail to the house and they ain't even living there, and they're asking. I'm an agent also, so they're asking me, Gus, do I have to live there? Yeah, I got a license. I can't sit here and lie to you. I'm not gonna lie to you. Yeah, you got to live there. You know what I mean? But you guys I may be wrong, so I'm gonna ask the professionals. Do they have to live there, and what is normally the portion of time they do have to live in that multi-unit?
You don't got to live there on day one, but by day 60, you're supposed to be in there. And you got to live there for a year, 1 year. You could try to go to the servicer and come up with, have an exception, and try to, see if you could get out of there sooner, whether your family size increased a crazy amount and you didn't expect it, different things, medical reasons. You could try to shorten that time, but the guidelines 1 year.
Yeah. I mean, so I've heard a lot of things from different clients about, well, I spoke to this lender and they told me X. And there are some lenders out there who will just tell you whatever you want to hear. Because of my background and still being a bar licensed attorney, technically, like there's just a line I have to walk. So the answer is, to echo Conor, you need to the guideline says you need to intend to take occupancy of the property within 60 days of closing, right? So and the general rule is you need to live there for a year. But he also mentioned sometimes life happens, and they're not going to penalize you for life happening and things that are unexpected. What they're looking for is intentional misrepresentation of what your plan is for that property. And so if you get into a home, and I've had this happen to a client, they got into a home and before they even moved in, it was like day 20, their partner unfortunately passed away, right? So that changes everything for them. Now they're not moving into this property. Now they're just listing it for sale. Their whole life is upended. They're going a different direction. That's not what they're looking for. They're not trying to come down on you and say, you lied, or you didn't, take occupancy within 60 days, or you didn't stay there for the full year and now you're going to pay the price. What they're looking for is people who have no intention of ever living there. And so if you have no intention of ever living there and you want to live in a super gray space and take on that risk, and you never mention that to your lender, and everything as far as what they're seeing looks like you are going to be taking occupancy of a property, then I'll tell you that there's really only limited ways that it can come up. But the moment somebody says to me, I had a buyer say to me one time in writing, we were so far into a transaction that was FHA, it was supposed to be owner occupied, and he sent me an email that said, I don't actually have any intention of living here. I'm using this for investment purposes, and put it in writing. And at that point, I had to say, I can't help you on this transaction anymore. Now, if you walk to another lender and you don't send them that email, I'm not saying they won't be able to get you to the closing table, but I now cannot, since you put it in writing, it's on my email server, we get heavily audited. I can't now in good faith push this forward as an owner occupant transaction. So yes, there are rules. No, they're not trying to come down on you for unexpected things. Just be aware of within 60 days of closing, taking occupancy, being there for a year. If you move out on day 363, it's not going to be an issue in my experience. But it's all about just like your intent and being able to stand behind whatever the narrative or the story is with a straight face. In the legal world, we call that the straight face test. Can you make that argument with a straight face? Same rules apply when it comes to these types of things in mortgage lending too.
Like, didn't that guy know your background, Alyssa? Like, come on.
Yeah. I know.
So the biggest thing is, even when Alyssa told that situation, it was an email that went to her, and she just said she gets audited, and she's not going to put our license on the line. I started the whole thing off with, if someone's asking me that question, I'm not putting my license on the line. And for you consumers out there and people who are looking to invest, you don't want to do the same thing. You think about it. You got to this point where you're in a position, you got qualified, you're able to go ahead and purchase a property that's going to generate some money, equity down the line, and so on and so on. Why risk it on, hey, I'm going to go ahead and do this small tactic? Those small tactics cost you a lot. The longevity game, and I try to preach this to everyone, it's the longevity game where most people win. Anyone that's trying to do something in a short span and they're trying to win with that short span, they normally lose. And then you see them complaining and, oh, it's because this happened. It's because I'm this and that and the third. No, it's not. It's because you look for a shortcut. Shortcuts are not always good. So I like your answer a lot on that. All right, so let's go ahead and move forward. Now let's get more to the vets that invest. Um, so I'm going to be honest. When I got into the game, I started with a commercial loan. So I never heard some of the non-Q routes before until I jumped on this app called Clubhouse. And I heard about hard money, private money, DSCR loans. I was like, damn, where was this at? Only in my area was either the regular type of loans or commercial loans. So I like that space right now. So if I'm a investor that's already got a track record behind them, what does that look for them when they're coming to you guys to go ahead and move forward? Is it the same deal? Are you using their previous properties as insight of what kind of investor they are? I don't know this, so that's why I'm asking from that perspective. Shad, if you want to go ahead and start with that.
Yeah, from working in the commercial space for a short time, but long enough to know, and then also being an investor who's invested with partners, and being asked, and I'm going to even answer this from a consumer space, being completely green. There was a time where the lender asked, "Hey, do you have access to any other partners who have a longer history of investing in real estate? Because this particular project might be bigger than what you could handle." Essentially, he didn't say it in those words, but that's essentially what the conversation was like. So lenders do, especially on the private side, non-QM side, um, commercial side, hard money side, they may actually ask about your experience in the real estate investment world. How long have you been investing? How many doors have you closed? That is a thing. Um, I'll let everybody else tie up, but from my experience, I have seen like your experience come into question, and not so much in like a negative way, but lending is about managing risk.
Mm-hmm.
And so they want to manage that risk when they ask you those things.
Yeah, I mean, the biggest thing for me when somebody owns multiple buildings and they're letting me know that they want to go buy another one in, 3 months, 6 months, if tax time's right around the corner, I always, you got to have an accountant, a tax guy that knows your plans, and you got to have a loan officer that's also clued in with those plans, because there's a lot of games that are played to keep those expenses down on these buildings, but we have to go off your most recently filed tax return. So if you're playing those games and you send us a tax return with a ton of expenses, you might not qualify for that next one. And now we're back to looking at DSCR, because we just can't look at those other properties, because they're killing your debt to income. So definitely get a tax guy who knows your plans, and keep them in touch with your loan officer. That's huge.
Yeah, I mean, to echo those guys again, like the great thing about seasoned investors is that usually they're not coming to you trying to slap a deal together at the last second and talking to you about financing, right? They're way out ahead of this. They know their plan, they know what they want to achieve in the future. So if they've got acquiring another property on their, vision board, whatever it is, 6 months in the future, they're going to be calling you up saying, I want to acquire another property in 4 to 6 months. Let's start talking about this. They understand the importance of having those conversations early. And so usually them having access to all of their documentation or completing an updated application with you, if that's necessary, isn't a hurdle. They're willing to do that. They understand why that's valuable. And then what I do with people who own multiple different properties is I want to see all the numbers. I want to see everything. I got to see the tax returns. I got to see the properties you hold. I have to work with your Schedule E's for rental income, figure out what we can use for qualifying. Does it make sense for us to proceed with a traditional conventional loan? Do the numbers work? Is that going to get you the most competitive rate? And not just like rate numbers, but do debt to income ratio numbers work? Are we going to be able to document everything that we need to support the rental income figures that we're trying to use? Do we need to get creative with that? And if that stuff all doesn't work, reserves to, then we can start to explore the other loan product options. But again, if you're coming to a lender at the witching hour, they're just going to try to ramrod you into whatever product can work, make sense in that moment. You're under a deadline. You've got to push forward. You're not giving yourself the time and the opportunity to evaluate all your options. And you're not letting your loan officer work for you and do what they're there to do, which is put all the numbers and the information in front of you, give you time to digest it, give you time to go back and look at your plans, look at your pro formas, and come back to the lender with more questions and have a strategy. And then going into that next property, you can say, okay, I can do a conventional loan up to X amount. And if I go over that or I need to, it's going to kill us on DTI. So we can't move forward that way anymore. Then we're going to pivot to the DSCR. And that's what this looks like. Or then we're going to, pivot to a bank statement loan if we don't have enough income. And that's what that looks like. the down payment requirement, the rate, this is how it's going to shift my numbers. But you already have all that information. You're armed with it ahead of time. So when it comes time to negotiate, you're fluid. You know your options. It's not the lender or the rate or the market that's like holding you back or keeping you from these opportunities. It's just you not giving yourself enough time to sit with the information and chart out your own strategy. You should be confident in your ability to negotiate and strategize and get properties that work for you and meet your goals. And you can be empowered to do that if you're working with the right loan officer. But if you're not giving yourself the time to understand the products and understand your options, then you're just your own worst enemy in these types of situations.
That's awesome.
Yeah, kind of brought up a super good point though, real quick, if I could chime in.
Yeah, of course.
For like future investors or I mean literally anybody, whether you're a business owner or just a 9 to 5, I had a buyer who wanted to step into the investment space. First time buyer, wanted to buy a multi-unit property. Um, Her accountant for years, now this is sad, that she didn't have the awareness to really like actually read through her tax documents. But for years, her accountant, and like Connor said, accountants and financial peeps play games with your taxes in often cases to protect you from paying Uncle Sam a bunch of money, right? And so for years, her tax accountant, her tax preparer will put these straw businesses on her account, on her tax documents, and which then show her losing money, right? And you say, well, what does that mean, right? Well, first off, that's fraud. But two, like it was up to me one time to say, hey, look, when are you going to invite me to your bakery? And she's like, I don't have a bakery. Shad, what the hell are you talking about? I'm like, sure, you got a bakery. Like, you ain't never baked me no cookies. You didn't invite me over for any brownies or something like that. I didn't even know you cook. She's like, dude, what the hell are you talking about? I'm like, page 2 of your tax return says, you know, Betty's brown bottom brownies or whatever. And I'm like, you can't be serious. Like, you have a business that you know nothing about showing heavy loss so you can get a better return. But now, again, none of that matters until you go to try to use Connor for a loan and say, yo, Connor, I want to buy a house, I want to step in investing. And now your tax returns are all jacked up. They're not real, they're fraudulent at this point, but also they're showing loss. So why do something or step into this space without really knowing what your documents are saying, and really knowing how to read contracts and read some of the paperwork that we work with. And that's, kind of going back with Alyssa's points. When you're a lender and you start talking about owning multiple properties, don't be alarmed when Alyssa asks you for information about a property that has nothing to do with this transaction. You say, well, I'm not buying that. I already own that. Right. But as a lender, we got to do our due diligence to research all your properties, right? And make sure we know all your properties, the taxes are up to date and that they're insured and that you pay your mortgage on time. So, like, we know people can get defensive and be like, well, what is she asking me for a property that I bought 5 years ago? Well, because you own it and there's risk.
My assumptions, and even when I'm speaking with my bankers, is um, make sure everything looks right so there's no hiccups on our end as far as us telling you, Gus, we can't move forward or anything along those lines. I may not want to hear that, you know what I mean? I may want to not any fraud, definitely not any fraud, but I may not want to hear that. Let me just put it that way. But at the end of the day, to keep me in a good space, I need to go ahead and hit certain numbers and make sure my taxes look good at the end of the day. So let's kind of end on this note. And what I want to do is I want to have a part 2 of this down the line, if you guys are open to it. Alyssa, Alyssa, give me a situation. It was complex. There was ups and downs, and you got it to the finish line.
Sure. I had a DSCR loan in the Boston area, really good opportunity. It was kind of crazy. This property was just above $1 million. It was 3 units. The rents on the units, though, were wild. And so if this buyer could make it work, it was a great opportunity. the thing is that, and all power to him, because we got it done, and he achieved his goals, but he wasn't the most qualified buyer. So he had other investment properties that he was holding. So he was selling one of them. So we were doing a 1031 exchange, which is a tax-free transfer of the sales proceeds from an investment property to a new investment property. So we had that element in there. That in and of itself doesn't make a deal complicated, but it was a factor. And then he also was short on funds. He needed to draw on equity on another investment property that he had to even be able to make the cash to close work on this new purchase. So we were running a home equity loan actually for him on an investment property to get him to that space. And then even still, when it was all said and done, he didn't really have enough reserves without us going and digging for reserves and putting that together. And so it was truly down to, dollars and cents, not because he can't do it, not because he's not equipped to own this property going forward, but to meet underwriting guidelines, he was right there. And so we went back to the drawing board, I want to say 4 or 5 times on assets, trying to make sure that we could get it all done. We have to take the home equity line and that draw into account when we're running the numbers, not for debt to income ratios, because it was a DSCR loan. So again, there's no traditional calculations like that, but we do have to take it into account when we're looking at where the funds are coming from, what types of funds you can use for things like cash to close versus reserves. And so there were a lot of moving parts. And we were up against a shifting rate environment. So we needed to get him locked in at the most competitive rate possible, but he was also trying to avoid inflexible terms. We were able to get it done on time. Everyone had their doubts, I think, but we were able to get it done on time, a little bit down to the wire. But we can, get creative and use that HELOC on an investment property when we need to make it all work. He got into the property of his dreams. He was able to, offload an investment property that wasn't working for him as well. And quite frankly, acquire a property that was double that value, and just the potential down the line is huge for him and his family. So life-changing, really. And those are the complicated, hairy deals that I enjoy personally. It's more fun and more rewarding for all these guys on this panel who we do this day in and day out. Sure, it's nice to have a easy 20% down conventional loan, owner occupied, 780 credit score. Who doesn't like that? But it's not where we really get to put our skills to use and help buyers achieve their goals and achieve their dreams. And not to make it sound fluffier than it is, but truly, like, this guy has young kids. This is part of their strategy moving forward. And he came from a family where he's the first person to ever own any properties at all. Like, you want to work for those people and you want to help them and you want to help make it a reality. And if we can put what we know on display and solve problems, I'm sure this is true for everyone here, but that's why I enjoy doing this job. And so, those types of transactions are way more rewarding in a lot of ways than the ones that are super straightforward.
I got one, and I'll try to keep it short and brief. And that was a dope story, Alyssa. Because like you said, the impact, is much different than a guy who never lived in the gray, and this was never an unknown to them, right? They had 780 credit, they had, endless assets, and it was just like not an if but a when, right? And it was never questionable, right? But much different, right? And so for me, I want to bring it back to FHA 203K, right? Because certain transactions that may not have been the plan, right? And so we know pictures on Zillow, they look really nice and Redfin and Realtor, or I'm a licensed agent as well. So if I send out an MLS link and a portal for somebody to shop, the pictures say one thing, but sometimes when you step into the house, it's completely different, right? The condition can be completely different. And so we went in with an FHA loan because a lot of my buyers, they come in with scratch and dent credit, so to speak, right? So credit scores lower. And until rules changed recently, you couldn't even do a conventional loan and get it approved with these kind of credit scores. So FHA is our only option. We're going in FHA, appraisal comes back with a ton of repairs. Now, this property, I don't believe it was as is. I can't remember. But either way, neither side, neither party had the funds available to fix this house, right? And on top of that, it's 2 floors, it's 2 units, it's a duplex. One of the other reasons why we were going with an FHA loan. So now what? Nobody has the money to fix this house, but we know she can do the financing. In fact, this house is well within her range, so she could, the numbers aren't going to make a difference between her getting this house. It's the condition of the property that's getting in our way. That's the obstacle. So what we did was we identified the repairs. We had a general contractor come in, price out the repairs, gave us a timeline on when they could do those repairs. And with the cost labor of the repairs, we factored that amount in to the FHA loan that we were already doing, that she essentially was qualified for. And all I did was, if there was about 40 grand worth of repairs, let's say, I just added that in to her loan amount. And so now we got the price of acquisition and the price of repairs put together in one loan amount. And so again, we didn't come in FHA 203K, it was FHA 203B for my nerds out there, right? We went in traditional FHA loan, but we find out this property needs a lot more repairs than we need. So once we put those two together and we showed that she still qualified with the higher loan amount, it was a piece of cake because it was the same financing. Again, FHA 203K is the same financial process. It's just outside of that traditional process the buyer endures. We're going over with the general contractor to make sure that they can do the repairs, that they're licensed and insured, and that they can produce a bid sheet, right? A workup. And so once we included the two and we showed that she could still qualify with the higher mortgage, it was a piece of cake. And so that to me was, that creative financing that the three people on this panel can tell you night in and night out. That's our job of saying, okay, well, this is how it was presented to us, but that's like a Rubik's Cube. This is what works. Mm-hmm. And so that's my little success story because I want to kind of bring it home with those FHA 203K loans. So that's just a personal passion.
Dope. That's dope. Conor, go ahead.
Yeah, I mean, Shad, I'm doing a lot of those too, the 203Ks. I mean, it's working. It's not what my craziest transaction was a 203K, but it has been working for me. I'm glad you brought that up. My craziest one recently, it was a unique property. It was an investor. They wanted to buy another property, but they had this Airbnb, and it was like more of a seasonal property. And they couldn't get a HELOC from any banks. They went to banks. Nobody would give them a HELOC to pull the money. So we did a 40-year cash out DSCR on it. And with those unique properties where investors are making a lot of money doing Airbnb, they sometimes think it's worth more than it really is. And, a residential appraiser will go out there and he's like, but you couldn't sell it for that. I know you're making this, but it's not worth that to somebody else. I'm sorry. So they didn't get the appraisal they wanted. But credit to them, they were gritty, and that's what you got to be as an investor. They went out there, they found their own comps, with the help of the realtor. And we did a reconsideration of value, and these don't always work for sure, but it did work on this one. We got their appraisal up. At the same time, the original plan, of course, was to do the cash out first, see how much funds you have, and then you can go buy your next property. But as we know as investors, they saw something they really liked before the cash out was completed. They wanted to get it under contract, so they get it under contract, and we don't know how much funds they're going to get from this cash out. So we had to get that reconsideration of value done. And they wanted to buy it as an investment property, this new one, but have their father, one of the partners' father was going to live in the property and rent a space. They didn't have enough money from the cash out to really make the investment loan work. So once I found out, okay, your father is going to live in the property, why don't we add him to the loan and we'll do it as a primary residence? Because a lot of people don't really realize this, is not everyone has to live in the home. Just one person on that loan has to live in the home. So we were able to restructure it, get the reconsideration of value up, and change it to a 5% down primary loan on the multi. with the father added. So it was definitely one of the crazier ones I've had recently, but I just wanted to keep it pretty short. But that one was, like Alyssa and Shad have both mentioned, those are the most satisfying. Like those buyers were so stressed out, to have a solution for them. You might have talked to me in day 22 of that transaction, and I wasn't looking like I was having fun. But like once it's all done, I love the roller coaster. I love having to
Yeah.
get in the trenches and figure it out, and getting through to the other side, because that's the big thing. A lot of people just tap out. It gets hard and they're just like, you know what? We can't do it. Maybe you should check with another lender. It's like, no, 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 no. We're gonna figure this out one way or another.
No.
You're not going to get that kind of advising if you call an 800 number and get transferred to a loan officer. So just keep that in mind. That's not an appropriate place for you to be if you're serious about real estate investing.
And that's
Nah,
why I
drop
wanted,
down mortgage, right? Drop down. Just look through
Yeah.
some drop down online. Drop down mortgage can help you.
Yeah.
Like, nah.
that's why I wanted you guys to take some time out to share that at the end here. And just real quick, I had a situation, my first deal with Connor. Uh, I got some of a guy I helped. He moved to Southern Maine, about 3 hours from where I am. He was like, "Yo, I got this guy Connor. He's a beast. He's an animal." So I introduced Connor to my FHA buyer. Let me not say FHA, but she wanted to be an investor. So her and her friend wanted to do it together. And so I'm talking to both of them, and out of nowhere, her in the midst of us putting an offer in, I think we're under contract actually. The friend decides she doesn't want to be part of it anymore, and she leaves this lady all by herself. And she's like, "Gus, I don't know if I could do it." Da, da, da. She's stressed out, and it is stress. Like I get stressed out. I didn't have gray hairs before I got into real estate. I got a bunch now on top. Um, so I get where she was coming from. So every day I was talking to her, and I know Connor was doing the same on her end. But there's key questions. Is this something you want to do? She said yes. So I'm saying, okay, so here's what we need to do. One, you need to educate yourself. You know what I mean? I'm here to help you as much as I can because my name's behind it at the end of the day. But you have to make yourself, and I like to use this phrase, a weapon when it comes to being in real estate. You got to understand the method as far as going out there and being successful. So I gave her a bunch of educational stuff. Connor and was able to figure out on the mortgage end because she didn't technically have the down payment money by herself. That's why she was going in with the partner. They were able to go ahead and conquer that part. She moves in. Now, I would like to say not she went on to purchase the property. I would like to say the story was all said and done there. Then she had these people move out, these people move out. She's calling me crying. And before she even closed, I was like, this is going to be very hard before it's going to be good. It's going to take a year to stabilize this property. If you're getting a property, especially if it has I'm looking like, okay, this has a bunch of opportunity. You got to go through those months you're in the trenches, getting people out, fixing the properties up, getting the rents where they need to be. So she called me every day, and I have no problem with this. I was telling you, you got to be prepared. You got to be prepared. You got to be prepared. And then as soon as she got it and two people stopped paying and one person moved out and she was devastated. But the good thing and where the story ends is she stuck with it. Instead of having her property management go ahead and fix, they char when property management, when especially bigger ones, they got so many people, so many clients, when they're getting different crews in there, it's more expensive other than if you were to do it yourself. So she was like, Gus, they sent me a bill to get this place turned and they're saying X amount. I was like, well, this is the time you got to roll your sleeves up. This is your place at the end of the day. That property management works for you at the end of the day, but that's the price they gave you. Either you're going to go ahead and do it, you got to figure someone else out to do it. And now she's asking, she gets in the place, she's like, okay, I'm going to do it. She's asking me questions. Someone, I'm not a contract, I'm the investor. So normally I'm just, working with my GC. She's asking me questions. I'm looking up in Chat GPT, trying to give her the best answers. We're figuring it out together.
Mhm.
And so she turned three places herself. She got the rents where they need to be. She sent just recently she sent me a gift in the mail and wrote a letter to it. And just how you guys explained your situation, that was one for me, which Connor was included in that, where we saw someone who didn't know much about real estate. They wanted to do it to the point where they got their 4 unit building up and running, and that thing is now cash flowing. And that's why I'm in the game. That's why I'm doing stuff like this. The money, I'm already got properties. If I want to just sit back and just collect money and live like Scrooge McDuck. I'm not saying I'm rich, but comfortable, I could do that. But I like doing stuff like this that's going to have people coming to us that are giving solid advice, that are giving real life situations, that if issues are coming to us, we can go ahead and help them navigate through it at the end of the day. And this is why I love doing stuff like this. So we're going to wrap it out like this. Connor, Shad, and Alyssa, if you can share your handle tags, if people want to reach out to you on social media, kind of if you want to start out first, and then we'll do the same circle and I'll close everything out.
Yeah, mine's real simple. It's just my name, Connor Whiting. Instagram, Facebook, LinkedIn, all Conor Whiting, Conor.
Instagram's the best spot for me. It's Alyssa Caliendo _mortgage. I'm on Facebook and YouTube and things like that too. So you can get there if you get to my Instagram. There's a link tree on there, but Instagram's where I post the most often, and where you're most likely to see the largest amount of content from me. That's the most kind of like time appropriate or topical. So.
Yep, I'm Shad Hammond on LinkedIn, Facebook. Same for me as Alyssa. I am mostly on Instagram as Shad Knows Loans, but I use pretty much all socials. I do have a little bit of more long form content on YouTube, but
Mhm.
predominantly you'll see me on Facebook and Instagram.
All right.
No TikTokers here?
Nah.
No TikTokers here. I was waiting. I was waiting to be that guy, that unicorn.
No, can't
No,
do it.
no,
But
nobody's
for
on the
people
top.
it works for, that's great.
I can't dance. But what I will say is if you watch this all the way to the end, there was a lot of good knowledge in this particular podcast. Something different. I want to go outside of the realm of just always talking about investing and methods like that. This is another realm of it, but it's more on the mortgage side. So I want to thank everyone once again. If you could share this with someone, if you can go ahead and subscribe. Last but not least, I brought it up slightly. I'm going to re-bring it up. I want to do a part two. So hopefully, if you talk to these guys, bug them, tell them that you've seen it, so we could do a part two. Same crew. I'm not even going to switch it up because I like how this whole crew worked. Other than that, I appreciate everyone tuning in. It's been nothing but a pleasure.